Hey guys, Grant here. Today we're going to cover a viewer question. Someone asked me the other day why depreciation is considered a non-cash expense, so I thought I'd create a quick video to cover just that. Let's get into it. So, as I stated in the intro, one of my viewers asked me the question, why is depreciation considered a non cash expense? So, that's what we're going to cover today in this video. So, to understand what a non cash expense is and furthermore what depreciation is, we first have to get an understanding of what capitalization means. So, when a company purchases an asset or something that they expect to receive future economic benefits from, they're not going to immediately expense that item. And when I say they're not going to immediately expense that item, I simply mean that they're not going to record that item on the income statement in the period that they made the purchase. They're going to capitalize that item, meaning they're going to place that on the balance sheet as an asset and expense that item or that cost over the useful life of that purchase. And to not spend this entire video talking at you, let me show you what I mean. So let's say that in year one, we purchased a machine for $100, and this occurred on day zero, right, in the very beginning. And I want to emphasize here that we spent cash up front. So we paid for this asset on day zero. And at this point in time, most people think, okay, we spent cash. Shouldn't we recognize a related expense? Under accrual accounting, the answer is going to be no, and let me show you why. So on day zero in year one, our company had a cash outflow of $100, and this $100 was used to purchase a machine. Now, this machine is expected to produce future economic benefits for us for multiple periods. And to be more specific, we expect to receive benefits from this machine in years 1, 2, 3, 4, and 5. And because we expect to receive economic benefits from this machine in future periods, we're going to take this $100 and we're going to place it on the balance sheet as an asset. Now, this is called capitalization, meaning we took this $100 cash outflow, and instead of putting it on the income statement as an expense, we are going to place it on the balance sheet as an asset, okay? So even though we had a cash outflow of $100, no expense has been recognized yet. And so we could think of the first part of this video as step one towards your understanding of why depreciation is considered a non-cash expense. Okay, let us continue. Let me explain why accrual accounting does things this way. And if you have not heard of accrual accounting, one, you could check out my video on the topic because I explain it there in depth. And two, let me give you a brief overview of what it is. It's simply a basis of accounting whereby we recognize revenues when they're earned, not necessarily when cash is collected, and expenses when they are incurred, okay? Not necessarily when cash is paid. So under accrual accounting, we want to adhere to the matching principle. That's why this basis of accounting treats cost in the way that it does. So under the matching principle, we want to match cost to the periods that generate revenue, okay? That's the core idea here. And what I mean here is that when we incur a cost, as I stated earlier, when we incur this $100 outflow of cash, we're not immediately going to expense it. We want to expense this cost, okay, or record this cost on the income statement as an expense as that cost or as that purchase, the thing that we actually paid money for, generates value for us, okay? That's the core idea. And this process is called cost allocation, okay? So we have a machine, it costs us $100. We don't immediately expense it. We record it on the balance sheet as an asset. Now, the useful life of this asset is going to be 5 years. As we stated up here, we expect to receive benefits from this asset or this machine in periods 1, 2, 3, 4, and 5. Okay, so that's what I mean by useful life. And just to be ultra clear here, this $100 is a cash outflow. Okay, look at my beautiful handwriting here. Cash outflow. Okay, so cash left us on day zero in year one, but we didn't recognize an expense. We capitalized it. Okay. Okay, now it's time to compute depreciation expense. This is going to be our non-cash expense. So we simply take the $100 cost of this asset and we're going to divide it by its useful life, okay? In this case, it's going to be 5 years. And this method is called straight line depreciation. There are a ton of other methods, but for the purposes of this video, we're going to use straight line depreciation to compute depreciation expense. So we simply take 100 divided by 5, that's going to get us 20. And this is going to be the expense that's recorded on the income statement as we use or derive value from this asset. So in periods 1, 2, 3, 4, and 5, up here, we're going to record a related expense of 20 bucks, okay? But it's not cash. Cash left us on day 0 in year 1, okay? As we stated up here. And it is that simple, guys. So we're going to take this $100 cost and we're going to allocate it over the periods in which we use this asset, okay? So in year 1, as we use this asset, we're going to have an expense of $20, okay? Year 2, 3, 4, 5, same deal, okay? But this is just an accounting allocation. This is not a cash outflow. The cash outflow happened on day 0 in year 1. Alrighty, guys, thanks for tuning in. Really appreciate your time. Like, subscribe, stay tuned. Thanks.